One of the biggest surprises in retirement is realizing taxes didn't disappear when the paycheck stopped. For some retirees, taxes actually become more confusing later in life. And I think this frustrates people because they spent 40 years hearing the same basic idea. Save into the 401k, defer your taxes, you'll probably be in a lower bracket later on. And sometimes that works, but sometimes retirement creates a trap that doesn't fully show up until your 70s. Let's call it a retirement torpedo. At first, retirement can feel surprisingly tax-friendly. Your wages stop, maybe Social Security hasn't started yet, maybe you're living partly from cash or taxable investments, maybe required minimum distributions haven't started yet, maybe your taxable income is lower than it's been in decades. And because those first retirement years feel calm, many retirees assume the tax problem is behind them. But for some households, that's actually the planning window, not the finish line. The trap begins when multiple income sources start stacking on top of each other. Social Security begins, pensions continue, dividends and interest show up, capital gains might occur, required minimum distributions begin, and Medicare premiums can increase if income rises above certain thresholds. Suddenly, retirement taxes are no longer about one paycheck. They're about interaction effects. One income source affects another one, and that's where retirees get blindsided. Let's use a simple scenario. Imagine a retired couple, both age 65, with $1.5 million in traditional IRAs and 401ks. They also have some cash savings and taxable investments. They retire, delay Social Security for a few years, and spend from the cash and after-tax money. For a few years, their taxable income may be really low. That feels good. But the traditional IRA keeps growing. Then Social Security begins. A pension continues. Interest rates are higher, so cash and bonds are producing more taxable income. And then required minimum distributions begin at age 73. For younger retirees, the required beginning age might actually be a little later on, but the basic issue remains. At some point, pre-tax retirement accounts generally have to be distributed, whether you need the money or not. Now the couple's forced to withdraw money from the traditional IRA, whether they need that much spending or not. And this is the part that surprises people. The tax system doesn't care whether you needed the money. It cares that the income existed. That required distribution may push more Social Security into taxation. It may push the couple into a higher bracket. It may increase Medicare premiums through IRMAA. It may reduce flexibility for charitable giving or Roth conversions later on. And you may now be paying net investment income tax or NNIT. And I've got a new Members Elite video on this tax on the way soon. If you're looking for even more clarity, that's what See the Forest Delete is for. This is where I go deeper, speak more directly, and focus on what actually matters without worrying about headlines, algorithms, or clickbait. At See the Forest Delete, you'll get access to members-only videos that aren't on the public channel. The Members Elite tier is just $9.99 a month. Hit the join button to enter. I'll see you on the other side. And now back to the video. Then you say, wait a minute. I thought retirement was supposed to be the low tax phase. I'm not working anymore. And sometimes it is, but not automatically. Now, tax deferral is not bad. I want to be clear about that. For many workers, contributing to a traditional 401k or IRA was a very smart decision. You reduced taxes during high income years, allowed the money to compound, and built wealth. The issue is not that tax deferral is wrong. The issue is that tax deferral creates a future tax liability. That's what deferring means. And if you never plan for that liability, it can become concentrated later on in retirement. Think of it this way. A traditional IRA is not all yours in the same way a checking account is. Part of that account effectively belongs to the government in future taxes. The exact amount depends on your future tax rates, your income, the state that you live in, the deductions you have, your filing status, and your planning decisions. But emotionally, retirees often look at a $1.5 million IRA and feel like they have $1.5 million. Then the RMDs begin and they realize every withdrawal has a tax partner attached to it. And that can feel really frustrating. I hear it all the time. The next layer is Social Security taxation. Many retirees assume Social Security is tax-free because they paid into the system for decades. But depending on provisional income, up to 85% of Social Security benefits can be taxable. That doesn't mean you lose 85% of your benefit. It just means that up to 85% of the benefit can be included in taxable income. Still, the emotional reaction is often the same thing. I already paid payroll taxes. Why is this being taxed again? And while we can debate whether the system is fair, the planning reality is what matters. IRA withdrawals, pensions, interest, dividends, and capital gains can all influence how much Social Security becomes taxable. So again, retirement taxes become interactive. A withdrawal from one account can affect the taxation of another income source. And that is why simply asking, what tax bracket am I in, is sometimes too shallow. The better question is, what happens if I add one more dollar of income? Because that next dollar may affect more than the bracket. It might affect Social Security taxation, it might affect Medicare premiums, it may affect deductions that you don't qualify for anymore, or the same thing with tax credits. It might affect state taxes. And this brings us to Medicare. Many retirees do not think of Medicare premiums as a tax, but IRMAA often feels like one. IRMAA is the income-related monthly adjustment amount. It's an additional charge added to Medicare Part B and Part D premiums for higher income beneficiaries. The frustrating part is that IRMAA uses income from a prior tax year, generally a 2-year look back. So a decision that you make now can affect Medicare premiums 2 years from now. A Roth conversion, a large capital gain, selling a property, taking a large IRA withdrawal, even one unusual income year. All of that can potentially show up later in Medicare premiums. Again, this does not mean retirees should never realize income. Sometimes paying more tax in 1 year is completely worth it. But you need to understand the ripple effects, because retirement tax planning is not just income tax planning, it's income coordination. Now, one of the biggest tax traps is widowhood. This is uncomfortable to talk about, but it's extremely important. When one spouse passes away, the surviving spouse usually moves from married filing jointly to single filing status after the transition period. But many of the household's income sources may not fall in half. The surviving spouse may keep the larger Social Security benefit but lose the smaller one. Pension income, it might continue depending on the survivor option. IRA balances may still be really substantial. Required distributions might continue. Investment income, that might continue. The house may still cost almost the same to maintain. So income may decline somewhat, but tax brackets compress significantly. That means the surviving spouse can end up paying higher effective tax rates on a very similar financial life. This is sometimes called the widow's tax penalty. And emotionally, it's painful because it often happens at the exact moment someone is least interested in complicated financial decisions. They're grieving, they're adjusting, they're managing the household alone. I've actually been going through this with 3 client households this calendar year. And it's not easy. And this is all because the tax system becomes less favorable after one spouse passes away. This is why retirement tax planning shouldn't only be built around the couple while both are alive. You should also consider the surviving spouse. Now, let's look at another scenario. A couple retires at 62 with a large traditional IRA. They have no pension. They plan to delay Social Security until 70. From 62 to 70, they live partly on cash and taxable investments. Their taxable income is very low. They think they're being conservative by not touching the IRA. But during those 8 years, they may have had an opportunity to do partial Roth conversions at relatively low tax rates. You don't have to convert an entire IRA all at once, but instead they leave the entire IRA alone. Then at age 70, Social Security begins. At 73, RMDs start. The IRA has grown. Now the required distributions are much larger than they would have been. The tax window has narrowed. They may still be fine, but they've lost the flexibility. And flexibility is one of the most valuable things in retirement tax planning. A Roth conversion is not automatically good. It depends on the tax rate paid today versus the expected tax rate later on, the cash available to pay the tax, the Medicare premium effects, the estate goals, the state taxes, and many other factors. But the reason Roth conversions come up so often is that they can convert future forced taxable income into more flexible tax-free income. The key word is flexible, because the retirement tax torpedo is not just paying taxes. Everyone expects to pay some taxes. The torpedo is losing control over when and how income appears. Required distributions reduce control. Widowhood, that can reduce control. IRMAA thresholds can reduce control. Large pre-tax balances reduce control. Unexpected income reduces control. Good planning tries to preserve control. And that may mean filling lower tax brackets intentionally in early retirement. It might mean coordinating Social Security timing with withdrawals. It might mean using qualified charitable distributions, or QCDs, later if you're charitably inclined. It may mean keeping some money in taxable accounts, some in Roth accounts, and some in traditional accounts. And it might mean not trying to minimize taxes this year at the expense of creating a much larger problem later on. And that last point's important. Many retirees are trained to think every tax decision should reduce this year's tax bill. And many CPAs believe this as well. But retirement tax planning is often about lifetime taxes, not just this year's taxes. Sometimes paying a little more tax now can reduce forced income later on. And sometimes realizing income intentionally creates flexibility. Sometimes the lowest tax year is not the best planning year if it creates higher taxes for a surviving spouse later on. And this is why generic tax advice can be dangerous in your retirement plan, because the right answer depends on the whole picture. Your age, account type, spending needs, Social Security timing, pension income, health, charitable intent, state taxes, your legacy goals, survivor planning. All of it's connected. Now, I know this can sound overwhelming. That was a lot of different things. And that's exactly why retirees avoid thinking about it. They want retirement to be simpler. They want to feel like the hard part is over. They don't want to spend their 70s thinking about tax brackets and Medicare thresholds. And I understand that completely, even though I love it. But ignoring the issue does not make retirement simpler. It often makes it more surprising. And surprise creates stress. The goal is not to become obsessed with taxes. Please don't do that. The goal is to avoid being blindsided. So what should you do? Well, first, identify your tax window. For many people, the years between retirement and when RMDs start are extremely important. That may be the best time to evaluate Roth conversions or strategic withdrawals, taking capital gains, or repositioning assets in your accounts. Second, make sure you understand your future income stack. What will income look like when Social Security starts? What happens when RMDs begin? What happens if one spouse dies? What happens if interest rates go higher? What happens if tax rates change? There's great software that I use that shows all of these different effects on a portfolio and on a retirement plan. I love looking at this stuff so we can take a look at what might happen in the future. And third, stop viewing the traditional IRA balance as fully after-tax wealth. It's a pre-tax account. Future taxes are embedded in it. The government owns part of it. That doesn't make it bad, it just means the account needs planning. And fourth, coordinate taxes with your lifestyle. The goal is not to win a tax game. The goal is to create a retirement income system that supports your spending, reduces surprises, and gives you flexibility when life changes. Because ultimately, the retirement tax torpedo is not just that taxes may be higher than expected. It's that taxes can quietly reduce confidence, and confidence matters. Because retirees who understand their tax picture tend to feel calmer. Not because they eliminated every tax, but because they know what's coming and have a plan for it. And that's the real value, not perfection, preparedness. Retirement taxes don't have to be scary, but they do have to be respected, because the decisions that you make in your 60s can shape the flexibility that you have in your 70s and 80s. And if you want to understand why even retirees with strong savings can still feel financially uneasy, watch this next video.